Welcome to Crypto 101, module number 6. In this module, you have 5 lessons. Lesson 1, Introduction to Decentralized Finance, DeFi. Lesson 2, How does DeFi differ from traditional finance? Lesson 3, Trading value on the XRPL's Decentralized Exchange, DEX. Lesson 4, What is an automated market maker, AMM? And lastly, Lesson 5, Understanding order books on the XRPL. Let's go ahead and get started with Lesson 1. Introduction to Decentralized Finance, or DeFi, making peer-to-peer trading scale. So, what is decentralized finance, or DeFi? Well, decentralized finance, often just called DeFi, is an umbrella term for various protocols and financial instruments that are built on distributed ledger technology, like blockchain. DeFi protocols aim to provide an open, decentralized infrastructure for financial applications. This infrastructure is designed to be accessible to anyone with an internet connection, regardless of location, identity, or wealth. Now, let's talk about the advantages of DeFi over centralized financial systems, or CFI. DeFi has many advantages compared to centralized financial systems, including improved security and resilience. The decentralized infrastructure of DeFi enhances security and resilience, reducing vulnerabilities associated with centralization. Another advantage is the absence of fees. DeFi eliminates fees comparable to those of traditional banks and financial institutions, making transactions more cost-effective. There's also increased transparency. The decentralized nature of DeFi enhances transparency, fostering trust and accountability within the financial ecosystem. And let's not forget about financial inclusion. DeFi extends greater access to financial services, especially to unbanked individuals, creating a more inclusive financial landscape. So what's been built in the DeFi space already? In the short time that DeFi protocols have been around, a great deal of progress has been made. Here are some of the most popular use cases and protocols in the space. First, we have DeFi lending and borrowing protocols. Anyone can borrow or lend digital assets using decentralized lending and borrowing protocols. You can connect to lenders and borrowers directly without having to provide funds or personal information to an intermediary. MakerDAO is one of the most popular protocols in this space. The protocol allows users to collateralize digital assets and then borrow against them. Next, we have DeFi liquidity provisioning protocols. Liquidity providers, or LPs, earn fees by supplying money to decentralized exchanges like automated market makers, or AMMs. LPs provide this liquidity by holding an equal value of 2 different assets in a liquidity pool. LPs are rewarded with a portion of the trading fees that are generated when users trade the assets in the liquidity pool. PancakeSwap and Uniswap are 2 of the most popular protocols for liquidity provisioning. Then, there are DeFi asset management protocols. Asset management protocols integrate with a variety of DeFi projects to automate the task of constantly tracking investments for price movements, rebalancing, liquidations, and rate changes. Yearn finances a protocol that provides smart vaults for digital assets. These vaults automatically invest users' funds in the highest yielding protocols and strategies, so that users can earn the maximum possible return when yield farming, which is using DeFi to earn interest on digital assets. Exploring the potential for growth in DeFi, one area of finance that can be improved by DeFi is the derivatives market, which is estimated to be worth over $1 quadrillion, 10 times the size of the global stock market. The DeFi derivatives market has only just begun to take off, with DEX leading the way. The total value locked, or TVL, in the DeFi derivative market currently sits at just over $3 billion. While this may not sound like a lot, this is a growth of roughly 200% in just a few years. With the launch of new protocols and platforms, we can only expect this growth to continue. It's not hard to imagine that the DeFi derivatives market could one day be worth trillions of dollars. That concludes lesson number 1. Lesson 2. How does DeFi differ from traditional finance? Decentralized finance can empower the globe with more accessible and transparent transactions. Decentralized finance, or DeFi, simplifies finance by removing middlemen. With fewer intermediaries, DeFi is more transparent, censorship-resistant, and faster to innovate than the traditional centralized financial system we're accustomed to. The increasingly widespread acceptance of decentralized finance marks a significant departure from the traditional finance landscape and centralized systems that have prevailed for decades. Our traditional financial systems have a few glaring problems. They have geographical restrictions, strict requirements of use, and limit innovation to a few chosen players. Going into the bank is easy for some and difficult for others, all depending on where you live. This problem is exacerbated in rural areas of the world. Traditional banking and finance also often involves centralized credit checks and complicated documentation. This can make funds less accessible to people who may have had a challenging financial situation, struggled with credit, or who don't have the necessary paperwork. In this siloed model, innovation and collaboration is not incentivized, and that just makes things harder for all of us. DeFi is all about giving everyone a fair shot at financial services. It stands for Decentralized Finance, basically doing everything the traditional finance system could, but without centralized intermediaries. With a well-executed decentralized system, we can borrow, lend, and trade assets without needing banks, middlemen, or other large financial institutions. This is a big deal because it helps level the financial playing field for anyone who has an internet connection to manage their money and be part of an equitable system. Because more people are able to transact and access a decentralized financial system, we're much more likely to see creativity and innovation from people around the world. Think of it like the open source web development community. Free and easy access to code bases and repositories means more developers collaborating and more developers building and improving existing libraries. Just like closed-source code bases, traditional finance technology will only evolve as fast as the owner or governing organization chooses. The SWIFT network is a great example of a lack of innovation in centralized financial technology. It was established in the 1970s as a messaging system to help facilitate international transactions and is still being used across the world today. SWIFT can only be used by banks and financial institutions and can be very costly due to currency conversions and intermediary bank fees. DeFi systems are resistant to censorship because transactions are recorded on a public blockchain. Transactions are visible to everyone, which increases transparency and reduces the potential for fraud. Conversely, traditional financial systems lack this level of transparency. Transactions and accounts can be subject to censorship based on regulations or decisions made by authorities. These factors make it more likely for participants in traditional financial systems to encounter hidden fees and fraudulent activities. Traditional finance relies on credit checks and extensive documentation to mitigate risk. In DeFi, some of that risk is held by the account owner because they must secure their own accounts or trust another entity with their funds. And most entities like that do not have the same protections banks do. That concludes lesson number 2. Trading value on the XRPL's Decentralized Exchange, or DEX. Swap what you have for what you want. Having tokens isn't very useful unless you can trade them. Luckily, the XRP ledger, or XRPL, was the first blockchain to feature a built-in decentralized exchange, or DEX. This means you can trade XRP or tokens without having to send them to a centralized exchange. The XRPL DEX is trustless. You don't have to worry about losing assets to hacks or thefts. The DEX is also non-custodial, meaning that you retain full control of your assets at all times. So what can you trade on the XRPL DEX? You can trade any asset that is held inside your XRP wallet, including but not limited to XRP-issued tokens and stablecoins. Imagine you run a learning club and decide to tokenize memberships. You exchange a 1-hour session for one Learn token. You only want to trade Learn tokens for USD, but you receive an offer to purchase the membership with tokenized gold. The XRPL is able to facilitate this transaction using auto-bridging or pathfinding. Auto-bridging uses XRP as an intermediary asset to find the best exchange rate. This is most helpful when an asset does not have enough liquidity to transact at competitive rates. Pathfinding uses a series of assets to hop from one currency or form of value to another, finding the most cost-effective path to convert tokens from one cryptocurrency to another. For example, if a seller wanted to trade their XRP for tokenized gold, pathfinding may find that the optimal path for this conversion is to first trade XRP for USD, and then trade that USD for tokenized gold. Just like with a centralized exchange, the XRP DEX uses a bid and ask system. A bid, also known as a buy offer, is the designated price a buyer specifies they want to buy an asset at or below. An ask or sell offer is the designated price a seller wants to sell an asset at or above. Assume the current price of XRP is 50 cents. If a seller wants to sell their XRP for 60 cents, they would place an ask order at 60 cents on the DEX. If a buyer wanted to buy XRP for 40 cents, they would place a bid order at 40 cents on the DEX. All bids and asks for each asset are tracked in an order book on the ledger. This feature improves market transparency and allows you to quickly see the best prices available for each asset. That concludes lesson number 3. Lesson 4. What is an automated market maker, also known as an AMM? AMMs speed up transactions through their usage of the constant function formula and readily available currency within liquidity pools. What do automated market makers, or AMMs, do? Well, AMMs are systems that let you exchange assets without needing middlemen. Each AMM holds a pool of 2 assets and enables users to swap between them at an exchange rate set by a formula. They're the most common way to implement a decentralized exchange, allowing everyday traders to exchange assets of various sorts for fair rates. The main alternative to AMMs are central limit order books, or CLOBs, which we'll talk about more in the next section. Fun fact, the XRPL currently uses a CLOB and has recently approved adding AMM. So, how do AMMs work? At its heart, an AMM works by pooling 2 tokens together in a pair of liquidity pools. Once enough currency is pooled together, the AMM automatically picks a fair exchange rate between the different currencies. AMMs figure out the fair exchange rate with a powerful formula called a constant function formula, which tries to model the price that a traditional market would discover on its own. Liquidity pools are handy for 2 reasons. First, because the prices are chosen automatically, everyday token holders can contribute without having to know what a fair exchange rate is. They're also useful because they can provide constant liquidity, as the pool is always willing to trade. Think of it like the exchange rate that is always available at your bank. As people trade within the pool, the AMM's algorithm adjusts the prices of the assets to keep everything in balance. If one asset is in high demand, its price goes up, and the other asset's price drops. This algorithm uses the constant function formula to keep things balanced. It sets a price that follows supply and demand for the various tokens. If there's a large supply of a token, exchanging for it will be easier. Conversely, with small amounts of a token in the liquidity pool, it will cost a lot to trade for the remaining tokens. On the demand side, trading more of a token at once is more expensive. You can think of the price updating automatically as you buy more and more of the token, reducing the supply as you go. Now, how does the XRPL order book differ from a typical AMM? A traditional order book system functions differently than an AMM, which relies on math formulas to leverage the liquidity pools in completing a trade. In the order book, trades occur when buy and sell orders match, allowing for more specific pricing, but can struggle to discover a fair market price if there are few traders. Trades on the order book happen when a buyer's bid matches a seller's ask, while an AMM executes trades instantly based on the current formula-based prices. In the next lesson, we'll dig into the order book on the XRPL and explain how it works. That concludes lesson number 4. Lesson number 5, Understanding Order Books on the XRPL. An efficient order book paves the way for a functional decentralized exchange, or DEX. In the last lesson about XRPL's decentralized exchange, we talked a bit about how the XRP ledger uses a central limit order book, or CLOB, to trade digital assets. This central limit order book not only ensures efficient trading, but also forms the backbone of decentralized exchanges. The order book is essentially a list of offers from traders to buy or sell tokens for a specific exchange rate. These orders are then sorted, and if there's another trader who would be happy to take that deal, the orders will cross and the assets will be exchanged. These offers can include XRP or any of the other issued tokenized assets, tokens representing various real-world assets. The real value of an order book comes when there's a large volume of traders. Then it becomes very easy to go from assets you have to assets you want for a fair exchange rate. This is often referred to as having high liquidity, because assets can easily be traded. Exchanges like central limit order books or automated market makers form the bedrock of DeFi, as a large portion of finance relies on easily being able to trade assets. The XRPL's built-in order book is a first-class feature with over a decade of optimizations. The XRPL was originally built to enable the Internet of Value, a way to move value as easily as data moves on the Internet today. As part of that, XRP was intended to be a bridge currency to connect all sorts of real-world assets using the built-in central limit order book, DEX. Just as you can translate between most languages using English as an intermediary, you can trade between any two assets on the XRPL DEX as long as they each have an exchange rate to XRP. In order to make that work, the DEX had to be very efficient. Since the built-in order book has been a first-class feature since day one, there's been over a decade of optimization to enable the XRPL's DEX to handle the transaction volume we see today. This unique approach of using a built-in order book from the inception distinguishes the XRP ledger from other blockchains, providing a solid foundation for its role as a bridge currency. The XRPL is one of the few blockchains to use a central limit order book rather than an automated market maker, and is actually in the process of proposing to use both. Other blockchains often implement their DEXs via smart contracts, which can make it harder to manage the state and computations involved in operating a central limit order book. Beyond the order book, why is the XRPL good for DeFi? The XRPL's competitive edge lies in its low fees and lightning-fast transactions. The XRPL's blazing fast transaction settlement and minimal fees are a result of its innovative consensus algorithm, setting it apart in the decentralized finance landscape. Because validators don't receive rewards from transaction fees, the fees are incredibly low, usually less than 1/100th of a penny. Additionally, since the network does not have to use computational effort to prove trust, like in proof of work, transactions can settle very quickly, usually in less than 5 seconds. These fast transaction speeds on the XRPL are a great complement to the built-in order book for facilitating real-time trading. Higher volumes of trades can pass through the ledger, which is essential for keeping prices up to date, especially during periods of high trading activity. Tokenization on XRPL is a straightforward process which only further enhances the platform's versatility. For example, you can tokenize a real-world asset on the XRPL with just a single transaction. By tokenizing an asset, you gain access to the fast settlement, broad trading options, and low fees the XRPL is known for just by creating an offer against XRP. In the next lesson, we'll explore auto-bridging and its pivotal role in expanding the scope of tokenized assets. By empowering users to trade a diverse range of assets directly and efficiently, the XRPL benefits from increased liquidity and a wider variety of practical use cases. That concludes lesson number 5. Congratulations! You have completed this module. Thank you for listening. I hope you have enjoyed these lessons. Look out for more teachings in this Crypto 101 course. The future is now, so let's learn about it.